I'd like to introduce Jim Lumberg, who's our investment advisor for the foundation. Jim, if you could take a few moments to introduce yourself.
I'd be happy to. Greetings, everyone. I'm Jim Lumberg. I've served the Methodist Foundation for a couple of decades now. I was a member of the board and part of the investment committee, and about 10 years ago, made a transition in my service to become the investment consultant. And it's really been a privilege to serve the foundation and to know the important work that's taking place and to be part of that. So thank you, Chris, for allowing me to join you today.
Thank you, Jim. It's a pleasure to have you serve the foundation and to be with us this afternoon. It's a gorgeous sunny day, and I know it's April Fool's Day, and that may be appropriate for what we're dealing with right now. There's a lot of uncertainty, but we're gonna talk about the issues at hand, which is how to deal with market volatility, and a little bit about the foundation's investments and how they're constructed, and how we can weather these storms through some tried and true principles. So first, I'm gonna share a presentation that hopefully you will all be seeing, and then if I've done this correctly, you can see Jim and I as little talking heads in the corner of the screen. We've introduced ourselves. I think most of you know me. I am an ordained elder in the United Methodist Church, coming up on serving 4 years in this position as the president of the United Methodist Foundation. First, I want to talk about how storms are a natural part of life. And I'm going to talk a little bit about what I like to think of as the pastoral approach to investing and why it's so important to respond as calmly and unemotionally and rationally as we can when we're dealing with invested funds, particularly in the stock market that can have some volatility. And I want to get into this topic by talking about something that we're all very familiar with, and that is lightning. Some of you maybe you're very afraid of lightning and thunder and storms in general, and maybe as children we all go through a phase where we're afraid of this very violent force of nature. And I wanted to share with you a few quotes from National Geographic and the reference to lightning to help us kind of understand why maybe lightning is a terrifying thing, but we come to observe it as something that is beautiful in nature and maybe even a necessary part of nature. Lightning strikes the Earth's surface about 100 times every second. So as I speak, just imagine that. Every second, 100 times, somewhere on the globe, lightning is striking the Earth's surface. Each bolt can contain up to 1 billion volts of electricity. As this electricity flows up and down from the clouds to the surface, the electrical current flows down the channel towards a visible flash of lightning, streaks upward at some 200 million miles per hour. About 2,000 people are killed worldwide by lightning each year, and hundreds more survive the strikes but suffer from a variety of lasting symptoms. And the average American has about a 1 in 5,000 chance of being struck by lightning during their lifetime. Now, as I tell you those facts about lightning, you might be thinking, well, that sounds very frightening, and yet I imagine most of us aren't really that terrified of lightning, although we know that it can be very violent and perhaps even deadly. And why would we react to lightning in such a strong way when we experience it or we're in the midst of a storm? Because we do feel that threat. And this is something that just happens without our control. It happens reactively. We have no control over it. The amygdala is triggered and we instantly go into that fight or flight response. And the same kind of thing can happen when there's market turmoil. Now, one of my favorite authors when it comes to the behavioral aspects of investing is Jason Zweig. He writes this in an article that spurred him to research a book called Your Money and Your Brain. He said this: the human brain is a superb machine when it comes to solving ancient problems like recognizing short-term trends or generating emotional responses with lightning speed. But it's not so good at discerning long-term patterns or focusing on many factors at once, challenges that our early ancestors rarely faced, but that we investors confront every day. So if we're looking at CNBC, just the general news media, we're logging into our accounts, our brokerage accounts, or we're looking at any number of the data flows that are bombarding us with information, the people that are generating that information often have the agenda of entertaining you and engaging that reactive part of your brain that keeps you glued to that news stream. And so it's very important for us to realize that they're tapping into something that we sometimes don't have a lot of control over, but through practices of mindfulness or just anything that helps us take our minds off of the volatility and the stream of information, we can choose to respond. We can use our mind to respond in a positive way to that reactive brain. The reactive brain is always feeding us these messages about, you must do something, you must act. And sometimes, oftentimes actually, that can be very negative to investment performance. So let's look at two graphs here that put this volatility in perspective. Here you see a chart from January 1st, 1950 through March 20th of this year of 2020. And you see the familiar red bars that show you the declines, and some of them have been dramatic declines, and the green bars that are the gains. And these are the annualized percentage returns for those years. And when you look at this chart, you might think, well, it's just so random and ad hoc, and I don't know when those downturns are going to come. So when I feel they're starting to come, or when I'm in the midst of them, I'm just going to get out, or I'm going to greatly reduce my exposure to stocks because I just can't deal with the pain anymore. Even though you might know by looking at a chart like this and just through historical experience that gains pretty much come pretty much soon after a downturn. What if we take the same data and just create a different chart that maybe you've never seen before? And it might look like this. This is the exact same data that you see on the left-hand side plotted in a different way. I'm just taking those actual percentages and mapping them as the greatest percentages on the bottom and then climbing it all the way up. So here your brain instantly sees that the green massively outweighs the red. So any tricks or patterns or practices that you can do to help your mind respond positively to that reactive brain by just flipping your perspective a little bit is going to help you be a better investor. One thing that we should do is we should try to turn out the noise as much as possible and focus on the experts that we trust and minimize our sources of information when it comes to decision making. You may have seen this quote, especially recently since Mr. Rogers has gotten so much attention. He said this: when I was a boy and I would see scary things in the news, my mother would say to me, look for the helpers. You will always find people who are helping. The same thing is true with investments. Look for the helpers. There might be experts on CNBC that are talking a million miles a second. They might know a lot of stuff about investing and might be very successful, but it's highly likely that they're feeding you an entertainment stream that isn't going to help your calm, rational, positive-minded decision-making when it comes to investments. Again, from one of my favorite authors, Jason Zweig, when it comes to investing, there's a world of difference between good advice and advice that sounds good. Investing is simply the struggle for self-control. Successful investing is about controlling the controllable. You can't control what the market does, but you can control what you do in response. It's hard to do, but you can control what you do in response. And if you're at all interested, I highly recommend just about any book written by Jason Zweig, or go to his website where he says this is a conflict of interest free zone. And he is there to help us be the best investors we can. And he has a lot of information and links to his articles that he's written over the years about the behavioral aspects of investing. With that, I want to turn it over to our resident expert, Mr. Jim Lumberg.
Again, greetings to everyone, and thank you for joining us. And I hope you and your families are staying healthy, and especially in this time of just a really incredible time. I'd like to focus on a couple of the themes that Chris just touched upon: scary things, things that are within our control, and just begin by admitting that this is an unsettling time in so many ways. In the midst of a pandemic, in the midst of market volatility, it's okay to feel unsettled by this. I'd like to focus on this graph that is being projected, focusing on the long term. I think it's the long term that gives us the opportunity to feel a sense of comfort and confidence in the markets today. What this graph is showing is the compounded annual return for the S&P 500 over a long period of time, from 1995 until just recently, March 15th of 2020. And what it shows is that staying fully invested in a portfolio of the S&P 500, that the return annualized over that period of time has been 7.3%. Now that sounds pretty good. And if you think about what's happened over that period of time, from 1995 to the current, we've gone through a lot of scary times and a lot of disruption and market volatility. Just think back to the tech bubble of 2000 and 2001. We've managed through the SARS epidemic in 2002. That was an incredibly scary time. The Great Recession of 2008. And if you just give yourself a moment to think about your recollection of 2008, that was an incredibly scary time when, logically you could just say the financial markets were just broken and that there was no hope for their return. We've weathered through an Ebola outbreak in 2014. The recession scare just recently in December of 2018. And here we find ourselves in the midst of a pandemic with COVID-19. There's been some really scary times, and this is one of them. It's unsettling. But if you think about the long-term behavior of the market, we can see that over a long period of time, that there's the opportunity to earn a very attractive rate of return. But what's required is that investors stay the course, not panic, to control the controllable, and to weather the storms. If you think about it, the way that I think about it very often is that as long-term investors, we have opportunities just to hold cash or bonds or stocks. And in the case of stocks, we really rely on equity returns for long-term growth. And typically, historically, equity holders are going to earn, about 5% premium per year, as opposed 5 or 6% premium per year, as opposed to just being in cash or some safe security. We know in the markets that there's no free lunch. And the way that we make and earn that 5 or 6% premium per year is to stay the course and to weather these kinds of storms. It's exactly now that as long-term investors, we really earn our money. It's not in the easy times when the market's gently going up. It's weathering these kinds of storms that matter. Now, if you're anything like me, you can look at this graph, and what it's trying to communicate is that if you're out of the market, even for the best 5 days over, a 25-year period, that the returns really suffer. And if you miss the 50 best days of this period, you'd have actually a negative return as opposed to a positive 7.3% return. So this graph is trying to communicate the importance of staying in the market and weathering the storms. And, if you're anything like me, sometimes you see these historical graphs or charts, and I might think, that's great, it's historical information, but it's different now. Well, it really isn't. And we just had a very recent reminder of the principles that are communicated in this graph. On March 20th, 22nd, 23rd, the market really was suffering and was down very sharply. And down on some days more than it had been on any given day since the 30s. But on March 24th, the S&P 500 was up about 9% in one day. So that's a very recent example of the cost of being out of the market and missing one of the very best days. So this, I think, will help us to stay focused on the merits and the reasons for staying invested for the long term, especially in the scary moments. Now, Chris, if you'll move to the next slide, as we think about disruptions in the market, they really are driven by one of three types of events. One is a structural event, which is characterized by some economic imbalance. We can think about 2008 with the mortgage crisis as a economic imbalance. That would be a bear market that's driven by a structural event. There's also bear markets that are driven by cyclical events, and that's just the natural cycles of economics, of growth, expansion, and then contraction. And we see these cycles happen over time. The third type of bear market is driven by an event. That might be 9/11 and the events that happened in September of 9/11, or a pandemic like what we have today. So today, our bear market has been driven by an event. It's a medical event, it's a pandemic. It's not structural, it's not cyclical necessarily, it's really driven by an event. So what we know historically, going back all the way to 1927, is that event-driven events or bear markets, normally they still are painful, but they normally do not have the same magnitude of drawdown that other types of bear markets experience. And historically, we know that event-driven bear markets on average have been down about 27%, which is less than structural or cyclical. On the next slide, we'll see that not only are event-driven bear markets less dramatic in terms of their drawdown, but most often over history, they are shorter in their nature. Because they are event-driven, they're sharper and they happen more quickly. And typically an event-driven bear market takes about 8 months from the highs to the lows, whereas a structural or a cyclical is more protracted, but they also take longer periods of time to recover from. Now, the bear market that we're in right now is especially sharp. We've gone from a high in February February 19th to where we are today in the matter of 5 weeks, 6 weeks. So it's really come on fast, and it's been unsettling. But there is some, this just gives you a better sense of context. The experts that we follow and our own team really believes that this is an event driven by a medical event, the pandemic, and that there's the opportunity, the opportunity and the probability that once the pandemic is under control and we start to see declines in infection rates and spreading, that this market will return. So Chris, on the next slide, I just wanted to touch upon a tried and true principle, which is diversification, and the importance of maintaining diversification in a portfolio. So what this graph is showing is annualized returns for different baskets of investments. The blue or the teal is 100% stocks. The gray is 100% bonds, and then the purple is the mix 50-50 stocks and bonds. And what we see here is that diversification can bring over a portfolio over a long period of time, less volatility, more predictability in returns, and a reduction in risk. So diversification, which is represented in all of the foundation's portfolios, is really an important principle. So we could see volatility in 1 year, but over a period of time, diversity provides more predictable returns with less risk. So diversity is really important, especially now. So to that point, Chris, on the next slide, let's just spend a moment to look at the 3 portfolios that are provided by the foundation. As many of you know and are invested in, there are 3 varieties. There's the conservative, the moderate, and the aggressive. Each of these are diversified across stocks or equities, bonds, and cash. And they've been constructed to be appropriate for different time horizons for the investments. And they're broadly diversified. Within the equities, there is a diversification in domestic equities or US companies across large companies, mid-sized companies, and smaller companies. And then there's also diversification internationally with international developed market companies as well as emerging market companies. In the bond area, there's diversification there as well. There is domestic bonds, there's international bonds, and then there's short-term bonds that provide stability of principal and help damper volatility. So one of the things that's really important in terms of the construction of the portfolios is this notion of diversity. And as many of you know, the Methodist Foundation constructs their portfolios with the underlying securities in adherence to the Methodist principles of the Methodist faith and the investment principles. The portfolios are index-based, so they're broadly diversified. They're meant to provide a market-based return with low fees, which really is a prudent approach for a long-term investor. Chris, on the next slide, we can see the performance of the portfolios and the results of a well-diversified, well-constructed, well-managed portfolio. And if we just look at a short period of time, even year to date, for the aggressive, the conservative, and the moderate portfolio, yeah, the portfolios are down. Returns have been negative near term, but of course we would expect that with the broad market performance. But our hope would be that because of the portfolio construction, the quality of the underlying securities, the discipline that is applied in managing those portfolios, that in down markets, the portfolio would not be down as much as the broader market. And that's proven to be the case across the portfolios. So it just represents the fruits of the discipline and the leadership of the investment committee led by Marta Rodriguez and the foundation board and Chris Walter's good work in his leadership. So with that, Chris, if you want to move to the next slide. I think we have questions and answers, and Chris, I'll hand it back to you, and maybe we can just engage with those that are with us and try to answer some questions.
Yes, thank you, Jim. There were some questions that were submitted upon registration, and I'm going to go through these and then we can talk a little bit more about them and answer any other questions that you might raise. First, how accessible is the money that we have invested through the foundation? And it's our standard practice to do contributions and withdrawal processing twice a month. So if you get a withdrawal form to us, which we prefer to have you scan that and send it to Carolyn or me, then we can process your withdrawal or your contribution request by the 15th of the month if you get it to us by the end of the previous month. And if you get it to us between the 15th and the end of the month, then you would have the withdrawal funds by the 15th of the next month. There was another question about how frequently can we reallocate the funds within an account or transfer funds to another account. Again, that's twice a month. And then are there any fees associated with this? There are no extra fees associated with managing the accounts of the foundation. The balance fees that we collect drive everything that the foundation does. So everything we do is baked into the income that we have from the balance fees of the investments managed by the foundation. So whether we're helping you with best practices or we're putting on the stewardship summer or the clergy tax seminar, which we ask clergy to pay $10 registration fee. So there might be some registration fees for events, but otherwise, any consulting, any work that we do with you as the local church or with donors, that is all baked into our ministry. There are no extra fees related to account management or to the mission of the United Methodist Foundation. One of you asked a question about, will earnings or spending policy distributions be distributed? Yes, everything is operating per usual. So while we are in a shelter-in-place order in the state of Illinois, everything operationally done by the foundation, other than dealing with physical checks and the mail, is all done in the cloud with institutional class technology providers. So all of that can be done and is done remotely on a regular basis. We usually finish the month-end processes within the first few business days of the new month. And then those distributions that go in the beginning part, usually on the first, go out during this time. And then there are some that go maybe in the mid-month that would be processed at that time. Jim, can you address this last question that was submitted to us about how does InvestNet deal with this kind of market volatility?
Yeah, I'd be happy to. InvestNet is staying with its core disciplines of long-term portfolio objectives and adhering and being guided by the investment policies of the United Methodist Church or the United Methodist Foundation. We're long-term investors, and we're seeing even the current market volatility within a long-term lens and remaining disciplined and true to the long-term objectives and strategies. We also monitor the portfolios very closely for adherence to the asset allocation, the way that we've constructed the portfolios to have an appropriate balance between equities and bonds and cash. and as the markets change, to rebalance the portfolio so that we maintain appropriate and consistent levels of predictable risk within the portfolios. Rebalancing also allows us, like in the current market, when bonds may do better, to sell appreciated bonds and buy stocks at a lower price. So it's a natural process of dollar cost averaging. We also monitor the investment managers that have been hired by the foundation to manage the different areas of the portfolio and make sure that they're adhering to the mandates that we've hired them to perform against. But also, we've found ourselves just in increased communication and engagement with the foundation. Marta has led us through the investment committee. We've been in frequent conversations. I've been working very closely with Chris, with David, and with George, and just staying close, especially now. So those are some of the ways that we're reacting to the market volatility.
Well, we will take advantage of depressed stock prices when the rebalancing happens. And we rebalance quarterly. So that's the beauty of being invested in these very diversified models, is that that will happen naturally through a disciplined process. Jim, can you add some more color on that?
We have targets that we're managing to in terms of the allocations of stocks, bonds, and cash. And when that becomes outside of our tolerances and the portfolios as a result have a different risk profile, we will rebalance. And that happens in one of three ways. As there are cash flows that are coming in and out of the portfolios, it's an opportunity to rebalance. So if we're light on stocks and there's contributions into the portfolios, we can buy more stock. If there are withdrawals, we can sell securities like bonds that have done better to, again, bring us back closer to target. The second way, as Chris said, is a quarterly discipline where we rebalance the portfolio naturally, and we're just doing that here at the end of the quarter. But then the third way is we follow the investment policies for each of the models. And if they are outside of a tolerance, then we will bring them back to balance. So it's through rebalancing that we're able to buy equities right now at lower prices. We know that, just look around at economic activity in your own neighborhood. Recessions are defined by 2 consecutive quarters of negative growth. And, that's where we're going to be. But it is likely to be short-lived. And if we can get this pandemic under control, the stage will be set for recovery. The market is pricing this in already. The market is super efficient and can see around corners, it seems. So we see a recession priced in, and the smart minds are even have handicapped where we start to see a downturn in the pandemic. But I feel like at the end of the year, we're in a recovery. And it really is just dependent on what's going on with this COVID-19, and if it's a seasonal thing and that it's no longer a factor, I think that we feel very optimistic about where we'll be at the end of the year. If it's not, then it's a different scenario. We've been asked, are we heading into a depression? And the answer is a very confident no. It's not zero probability, of course, but today looks much different than the Depression did. If we look back to the Depression era in the 30s, we did all of the wrong things, and we did them all at the same time. In terms of monetary policy, we did all of the wrong things, and we did them all at the same time. In terms of social policy, we did all of the wrong things, and we did them all at the same time. In terms of monetary policy, We tightened as a government, we tightened the monetary supply. So we restricted the economy through monetary policy. In our fiscal policy, we didn't decrease interest rates, but we increased interest rates. In terms of trade, in an effort to produce more at home, we imposed more trade tariffs. So we had a restricted trade policy. And in terms of regulations, there was increased regulation. So it was the four levers all pulled in the wrong direction. We made all of the possible errors. Today looks much different. If we look at Fed policy and what the Federal Reserve is doing, we learned a lot from the Great Recession in 2008. We learned a lot in terms of fiscal response, but also have a whole new set of tools to respond to the economy in a way that is supportive in a crisis like this. The Fed has been very proactive, and they have been incredible in terms of their response to say they have unlimited ability to intervene and to support this market, not only in buying bonds, but other assets as well. So the Fed is better equipped today than it was in 2008 and much more proactive. The legislative support has been much more robust today than it was in 2008. And part of that is, surprisingly, there is political agreement in terms of alignment, in terms of responding to this crisis. If you think about 2008 and bailing out the companies, they were largely financial companies that were being bailed out. And there wasn't political agreement at that point because some of the argument was, why would we bail out these companies that got us into trouble? Well, today, the government just announced a $2 trillion economic stimulus. And to support companies, it's not the company's fault for the pandemic, and there's broad, aligned political support to do whatever's necessary. That wasn't the case in 2008. The other thing is that this is an event-driven bear market. We talked about that earlier, but we went into this with a very strong economic foundation. In February of 2020, unemployment was at its all-time, or nearly at its all-time lowest at 3.5%. So it was a strong economy, strong fundamentals, shocked by an event. And as we come out of this medical event, we will build upon the strong economic foundation that we had. And I think too, there is reasons for encouragement just in terms of medical responses. We know that the best and brightest minds in the world are focused on treatment and vaccines. And as Dr. Birx and Dr. Fauci talk about kind of bending the curve. And we're seeing really encouraging responses. Even right here in Northern Illinois, Abbott Laboratories just announced a rapid response or rapid results test for COVID-19, which is a key to addressing this pandemic. So in terms of the fiscal policy, the government response, the strength of the economy that we had before this event, and just the full force of our best thinking to solve this, I think there's a lot to be encouraged about. It doesn't remove the pain, but it doesn't leave us in a place where we're hanging on the precipice of a depression. There is reason to be encouraged, and I just wanted to leave with those words.